Okay, so welcome to, believe we're in our fourth week, fifth already. It's amazing how quickly this has gone, and you guys are doing great. I'm just gonna open up our page for a minute. Just want to check in. So we are in week 5 already. It's amazing. But how fast these classes go. So far, very good job. I'm gonna grade the rest of the week 4 work today. But from what I could see, I give it a quick look. Everything looks good. You're following the directives, getting it right. You're watching the videos, you're watching these videos, you're watching the other videos. So I think it's really helping, obviously, because from what I could see, getting some real good work out of the class. So it's being reflected in the grades. Just keeps, and you guys are on time on top of everything else, which is great. You're staying on top of your work. There's no late submissions, which is helpful because you don't want to fall behind. You want to keep the same cadence, the same schedule. So as I move on, you're moving on with me. So you not have to catch up, watch videos late, and that sort of thing. But I don't know why I'm even saying it because you guys are all pretty much in line. So we're in the 5th week, and we've done bond valuation, and that was pretty interesting, I thought. And it's always a good thing because it comes into play so often in our investments and when we borrow money, which is a frequent thing for just about anybody. Okay, the need to use the bond markets or to use the debt markets, really comes into play no matter who you are. You can say, well, Jeff Bezos, he's got all the money in the world. Yeah, he's got a company, right? They have to borrow money. So just about everyone has that need. And interest rates affect everything we do. So that was, and if you've been following the papers, and I urge you to do that, you'll see that interest rates have moved up, right? Let's share my screen for a minute. So just as a recap on the bond market, interest rates have moved up. And we see the 10-year, which is the harbinger rate, which is the rate we generally follow, is already up to 1.812%. So if you look at this rate year to date, we were as low as 1.7, but let's look at it over the last year. Rates traded in the last year as low as 1.175 going back to last August. And if you go back to last year at this time, we were at 1.13. Now that might not seem like a big move, 1.8 from 1.13, but believe me, it is big. And if you go back to 2020, you had the 10-year was as low as 0.729. So you would say, well, what's a 1% move? Well, do the math. 1%, or 1.1% on 0.7% is over 100, it's 150% movement. And when you do the time value of money or the loss on a bond, you see that. You start to see that kind of loss, those losses trickling into the market. And that's kind of why you're seeing the markets react so violently over the last couple of weeks. And I know most of you took this class and you must be interested in the markets. We're noticing that the markets have definitely retraced. And when we use the word retraced, we mean they've gone back to levels that they were previously. So in particular, if you look at the NASDAQ, there is the NASDAQ, which is representative of most of the tech stocks. Well, over the last year, it traded as high as almost 16,000, and it's bounced back to some extent. It's back to 14.2, but traded as low as 13. So we start to see this, and it's had an incredible run. I mean, it was at 8,000 in 2020. So needless to say, I mean, even though we've given back 2,000 points, we've had a great run since 2020. So if you're in tech stocks, you shouldn't be complaining unless, as I say, you're using this as a source of income, which I think is always a dangerous thing. Sometimes people, say, well, I make X, or I'm retired and I get X in my fixed income investments, but Social Security or whatever you do, and I'm going to rely on the markets for the rest of my income. Whenever people tell me that, I'm like, it's not such a great idea because markets change and markets go down. And even the housing market, I mean, I'm sure all of us realize, the housing market has been booming, and that might continue for a while. That's more glacier-like. It's not as liquid. But that doesn't mean, you can't see a retracement. These are markets. These are valuations. So why would the NASDAQ react more violently than, say, the the Dow or the S&P, because it's growth stocks. Tech stocks are growth stocks. People buy tech stocks looking for growth. People buy the Dow looking for security, right? The Dow, IBM or 3M or the Minnesota Manufacturing Mining or Coca-Cola. You're buying those to preserve your money and get a good rate of return, better than treasuries. But when you buy NASDAQ stocks like Apple or Facebook or any of those stocks or Tesla, you're looking for growth. And if rates go up, money becomes more expensive, and the growth factor is discounted by a greater extent because we're relying on growth. We're not relying on steady income. So those stocks should react more violently because of the need to grow. And the more expensive the money, the hurdle rate goes up. Effectively, you have to meet a higher hurdle rate. So that's what I want you to pull away from this. And as I said in the past, very important that you continue to read the papers, or at least if you're not going to get the papers delivered and you're students, so you get the student rate, at least make sure when you open up your browser, you have these you have these pages bookmarked, which you see. I even have my local paper bookmarked. So this way, it's the first thing you're looking at in the morning and you're getting your news. Really important that you do that. Okay, really important. So that's it. There's a lot of good articles here. But let's go to our work now. Let's go to our work. So the most difficult thing you're going to have to do this week is probably, next week we wrap it up. It's probably, in my mind, one of the more kind of challenging, not in a bad way, but one of the more challenging things that you have to do is simulate a model. So what does that really mean? Let me open up my Excel. So simulating a model, what are you saying, Professor? Well, it means we're going to build a model, and we've been doing that the whole time, using the bond markets, using equities, using everything, right? We're learning how to build a market, right? We're learning how to build a model. And now what we want to do is we know that according to the efficient market hypothesis, and that's why I included a lot of that information in this week's work. According to the efficient market hypothesis, everything that's knowable in the economy should be reflected in prices, right? So we know there were the three phases of the efficient market hypothesis, Modigliani and Miller's efficient market hypothesis. And the first says that, there's the weak form, there's the semi-strong form, and then there's the strong form. And it's just different versions of what should be reflected in the market. So let's take a look at that just as a review. So why is this important? Well, we're going to see right now. So you have the efficient market hypothesis, right? And what it says is, in its different forms, information that's out there should immediately be reflected in the market. And if you study economics, you could see why that's important, because we want all information to be in the pricing system, so that this way we have the most accurate reflection of what the prices should be. That a price actually reflects at any point in time all knowable information. And why do we subscribe to that? Well, think about the millions and millions and millions and perhaps billions of people that are involved in the markets at any point in time. You would assume that with all of that liquidity, prices will reflect all knowable information. So in its weakest form, the weak form, the EMH claims that all past prices of a stock reflects today's stock prices. So the efficient market hypothesis really centers around the stock market, only because it's the easiest thing to measure, but we can apply it to anything. And the semi-strong form implies that it's all public information and some analysis that is being done by stock professionals or even just amateurs who have good analytical skills. And in its purest form, we assume that even private information is reflected in the market, which would be theoretically illegal, right? Let me just iterate that. If you were to come across private or non-public information that will affect the stock and you trade in it before it's disclosed. So for instance, you have a friend who's the CFO at a publicly traded company, and you're having a drink with that person, and they say, if you drink of it, and they say, well, you know what? We're going to have earnings next week, and they're going to be terrible. And you go out, now no one else knows that, but you and I guess the people who run the company, and you go out and sell the stock based on that, or buy an option to profit from it. You go to jail for that. I mean, that's insider trading. So in this country, we assume that only information that's tradable, or the only information that should be knowable, is public disseminated information that affects the stock. So this is in order to make the markets fair. So by proxy, you're not, we would assume that private information isn't reflected in the stock market. But in its strongest form, M&M proposes, Modigliani and Miller propose that all information is there. So if all information, so let's stop there for a minute. If all information is reflected in prices, even your house, all information is being reflected, even the price of your house or your car, all information is reflected, right? There's so many cars on the road. Like, even though you might own I don't know, if you own a Cadillac or you own a Buick, you know, there's so many of those cars out there adjusting for age and different wear and tear, you get a value because there's just so many out there. So if all information is out there, then the next movement in an asset is unknowable, right? The next movement in an asset is unknowable. What's going to happen tomorrow in the markets or to the value of your home or the price of a box of Oreos is really unknowable. Anything is possible. We know that with COVID, right? Anything is possible. So if that's the case, then what we say is asset prices follow a random walk. That's what that means. So the random walk means that we assume that the next movement is random. It also assumes that it's very hard to predict the markets. That's why my advice always to anybody who asks about the markets is if you find a stock, and I kind of go along with Buffett, and I think I included some of his stuff in our class, if you like a stock or you like a company, you've done your analysis and you believe in that company, well then just put it away and hold it and don't look at it. Because the daily movements will drive you crazy. But if it's a good company over time, that's how Buffett made his money. You'll do well. You'll do well. I remember I told you that story about that friend of mine whose parents were Russian immigrants and, had a trucking business in Lower Manhattan in the 1940s and 50s, 60s, 70s. And they started buying a stock. They kept kosher, which means you're not supposed to eat anything that's not kosher, right? They were religious Jewish people. And they just kept buying the stock, and they never looked back. They never looked at the price. They just bought it whenever they had the chance, and they made a fortune. Well, they made a small fortune. That really helped their family. One guy opened up a big pharmacy. The other one is a person that I knew. She was the head of the English department at St. John's, where I went to school in New York. It was McDonald's. So that's the theory, right? The theory is we follow a random walk, and that gets us to what I want to teach you today. Is that when you create a model, somehow you have to introduce that randomness. Now, one of the more important formulas that we would use in Excel will be the random formula. So sometimes I forget where they put these things, so just bear with me. But let's see if I can search for it. Okay, so there's random. So there's the random function. So it's equal RAND parentheses. And when you put that in and add it, you're going to get a random number between 0 and 1. And that's what the random function does for us. It generates a random number between 0 and 1. Okay? And every time you hit enter, you're going to get a new set of random numbers. Let me just copy that and paste it. I'm going to paste the formula. So notice I've created 11, for some reason 11, I should have did 10, which is neater. I've created 10 random formulas, right? And I can sum them. I can average them. Let's average them. So if I wanted to do this random idea of something, right? So let me just show you a simple simulation. So I'm going to average these 10 random numbers. Okay, hold on a minute. I did something wrong. Bear with me. Okay, you go, it's equal average. And so, average. And I'm going to sum up these random numbers. And you know what? It's always helpful if you're doing a random, if you're generating random numbers, to have even more than 10. You can have 1,000 of them. The more you have, the more random it is, frankly. Because of the central limit theorem, right? Remember, if you studied your statistics, if you have more than 30 or more, your distribution starts to look normal. So we're just going to use 10 for now because not to waste time. So every time, look, watch happens every time I hit enter. Now that's the sum. That's the average. The bottom one is the average. The bottom one is a function of the top 10. So every time I hit enter, notice how it changes because all those numbers are changing. Hold on. Should keep changing. Let's do this. Now I get other ones. Notice, see, I get more of them. And you're going to keep getting it every time you calculate, okay? Every time you calculate, these numbers will change. And in effect, your average will change, okay? Notice how it keeps changing. And it'll keep changing, and it'll keep changing. So, and so you'll get different averages. And then whatever number you're trying to create, you could make it a function of that average. So let's say it was, I don't know, the average sales in a certain product, which are definitely random. Well, you can find the average and multiply it by your profit. And that's going to give you a different number every time you regenerate this set of variables. Your average should change. Okay. So having said that, let's do another one. Let's see again. Now you got a new set. So we can keep doing that and keep generating random variables. Okay, notice that it keeps changing. It just keeps changing. Okay. And that's a simple simulation. And then I can average my averages. So you can make this as random as you want, as long as two things. As long as you have, I would suggest some sort of normal distribution. Because if it's not normal, then you're kind of losing, you don't have to get too deep into the math. But if your variables are not normally distributed, for those of you who study statistics, you're gonna, you're relying on, a lot of this relies on theory, and then you got some faulty theory there, because if it's not normal, then we can't expect an average number generator to be correct. So just remember that, it's not something you have to obsess over, because as long as you have more than 30 or 40 variables, you will have a normal distribution. So if you're going to create a generator, I would suggest having more than 40 or 50 items, and that will work. That's the easiest way I can explain it. But if you're a statistical oriented person, you want to have a normal distribution, because according to the central limit theorem, if the 30 or more, 40 or more observations, my distribution looks normal, and I could use this random generator. The second thing is, once you have that, you have to always assume that whatever your outcome is, it's random. Like, for instance, if I'm running a business and I know that at the end of every year, because of the holidays, because of Christmas or whatever you celebrate, Hanukkah or anything you celebrate at the end, Kwanzaa, whatever, there's sales. People give out gifts. End of the year gifts. You don't even have to, they could just be end of the year gifts. We know that there's more commerce on a seasonal basis. Well, then my random generator has to account for that because it's not truly random at that point. So it has to be something that's really, we consider random, that that we can't rely on, that any number could come up on any given day. So remember those 2 points. All right, so assuming that you took all this in, now what I want to do, and I think it's really important, I found a video. This teacher did a great job. It's simple. Because the stuff we're going to do when you do, and I gave you I know I gave you an example. Here, I gave you an example for review only. I'll download it for a minute. And you can download that. And this is a review. You could use this. Of course, I want you to make up your own, but at least you're getting a idea of what your answers should look like. Okay? And then this way you could work off of that. Basically, what our work this week dealt with is we have a probability distribution, which is the different probabilities of different demands of our product. And that will give us randomly generated the number of wafers we make, the cost, and then we can randomly generate how much sales we will have. And this way we could sort of predict what level of production we need by looking at our sales. And we could by averaging enough of them, we'll come up with an average that allows us to arrange our assets so we're ready and we're prepared. So we're not underproducing or overproducing. I mean, even think about it if you're watching a football, so for those of you who are football fans, and I don't advocate gambling, but we know that every week the odds makers come up with a point spread, right? Even for the Super Bowl. What they're really doing is they're looking at many games before. They're putting a limit, right? And we don't expect one team to beat the other team by 50 points. And we don't expect, and there's no negative number. So we call it log normal. What we would expect in a game like the Super Bowl coming up, it should be anywhere from a 3-point victory for a team, maybe a 2-point victory if it's an exciting game, to maybe at the worst, 20-point, 21-point, something like that. So they put a limit on it statistically. And then they generate a lot of random numbers after they've added all their known variables. And that's how they come up with a good estimation. I mean, simply speaking, somebody say, well, it looks like around 3 points. But if you don't want to lose money, and believe me, in Las Vegas, they're a lot more sophisticated than you think they are. And that's why they're in business. They've got statisticians running numbers. And even at McDonald's, they're doing that to get an idea of how many hamburgers they're going to sell. So let's watch this video together. And I'll put it on you can watch it at home. Because that's why it's here. But it gives us a good example of, and another way to call a random simulator, we call it a Monte Carlo simulation. So this week's code word is going to be Monte Carlo. Just for you guys, the code word is Monte Carlo. All right, so let's go to week 5. So you have your example. Let's watch the video together.
This video.
Okay, I'm going to put the closed caption up here somewhere so you could follow it along. But hopefully you hear the video through it's only a 6-minute video, but I'd like to do it together. And very well done video. And matter of fact, I'll include it in my playlist. And watch it again at home, if it doesn't come in clearly. Plus, I would suggest if you could replicate it, always a good thing to do academically. If you have a few minutes and you want to replicate this just to make it work on your own, I would recommend that because it'll further force the understanding of how to do Monte Carlo simulation.
So let's start with a basic example. Given your revenues, your fixed costs, your variable costs, and so on, let's check your revenue. So here's the situation. It's a project. Estimated revenue will be 15,000. In other words, it's plus or minus 1 standard deviation goes up 15. So minus 2 standard deviation would go by 30. Fixed costs are 60,000. So standard deviation would be. This is assuming that there's a normal distribution. Which one? So that's assuming it's all distributed. So you can use that and then to get a normal distribution. It's revenue. And it's like so this is and is your first simulation of what your profits are going to be. Maybe I'm going to do is actually do number simulations and all of them. Try profits. Series. Series. Call. Here. So, chip. Life analysis. Yeah. To celebrate. So celebrate. Thank you. And populate this.
So let me just stop for a minute right there. So what this professor did was she puts in expected revenue. Of course, you can always have fixed and variable costs. Now, among those costs, just to recap, fixed costs are going to be more than one cost, right? You're going to be insurances, rent, anything that's fixed for at least a year. And your variable costs are going to be everything that varies with your units of production. To make it simple, she combined them. And, otherwise, if you were doing this with, real money and real business, maybe you want to play around with all your variable costs because the fixed should stay the same. But you might want to do a random generator among your variable costs. So this way now you get even a more accurate read, and what are you saying, Professor? Well, let's say I'm running a candy bar chocolate company. Well, we know that the price of cocoa vacillates, right? Price of cocoa moves, sugar moves, those are commodities. I may want to throw a random generator with limits around those variable costs. Or and then and what that does for me is not only does it show me the variance in profit, but it might even urge me to do some hedging, right? So I protect my profit. So, stuff that's intuitive that business people already think about. You don't have to be a PhD in applied mathematics to know that if you're running a chocolate company, you got to watch your sugar and your cocoa costs because they're variable commodities, even your energy costs. Um, by running these simulations, it really brings home not just that there's variance, but how much variance. And then, of course, she put these standard deviations in here, and that gives her a simulation because she's going to assume so many standard deviations to do her simulation. And then when she did the what if analysis, it's going to generate different profits, and then that's going to average out to be one profit. So she's really done enough data, as she said, to turn this into a normal distribution. So there's a lot of stuff here that you can unpackage. What if analysis, random generator, that sort of thing. I'm just gonna go back to 2:45 so we can review that one more time with that in mind. Go back to 2 minutes.
Yes.
So when she did the norm dot in, if you go back a little bit, when she did, I'm gonna stop right there. Notice that her formula was the normal inverse, so she found the normal distribution and then put in the random number. So she added the random number for the standard deviation. So she randomized the standard deviation because that will vary and that'll affect her normal distribution.
Is. That right there is your first initial. So we're gonna deal with it with the number simulations and all. Factors. Circles. Here. So table, shift down.
So just for the benefit of those folks who haven't studied statistics, what she did was she does her expected values, then she puts in a standard deviation based on the normal distribution. And then the randomness is the number of standard deviations. So when she gets the number of standard deviations, then she could multiply those standard deviations and come up with a new value for the variance from the average, and that's how she comes up with a simulation. So in this case, she expects a variable cost to be 100,000, but based on a negative simulation, her variable cost went down and her fixed cost went up, but her revenue also changed. So she's constantly generating new numbers. I got to tell you, this is a brilliant woman. So I'm not going to, her methodology is tremendous. I'm not in love with how she handled the variable costs, to be perfectly honest. Because here, fixed costs are pretty fixed, but a variable costs really move, and they don't move as much with revenue. And I don't know how much I love it. I think you got to be more careful just in your own simulations on variable costs. Because variable costs, to some extent, should track production. They should better track production. But that's going to probably be a more sophisticated model, probably something you need to buy off the shelf, meaning that companies will sell you that or even do the work for you. So if you ran a business and you need this kind of information, there are companies that will do it for you or sell you software for it. And that's enough if you understand. But at least you'll know what their methodology was.
What if analysis? Data table? Two cell, choosing an empty cell. Six cells to work in. And should populate this. That's what I'm gonna do. So what's my average here? Let's name this. I don't know what's gonna be.
And that was pretty clever what she did there, because even though she's going to get an average profit by doing all this work, she's also showing you the range, right? We call that in stats the range. You're seeing the minimum and the maximum. So not only are you seeing the average profit, but you're seeing the variability of profit. So you could see the potential loss, which in Wall Street, if you use value at risk scenarios, we always want to know what our worst case. I mean, the best case is great. You know, if you get a profit that's 2 or 3 standard deviations above the mean and it's an outsized profit, and we know that can happen in the markets. You wake up one day and a $30 stock becomes a 300. Hey, happy day. Nobody has an issue with that. But the real thing you need to always keep an eye on is how much can I lose here? And always keep in mind that the maximum loss is zero. So, but that's not the case in a business. Maximum loss is not a zero in business. You don't go to zero. It's not a stock. So in a business, you can lose unlimited amounts of money, theoretically.
And then I realized, this session was fine. This kind of. Right? Yeah. Two. Six. So it's got 22% of the time. So you can keep recalculating that. Let me just calculate now. You'll see there's a slight variation with almost random selection from this distribution. You might want to use more trials. So what this is really doing is randomly distributed. Random is the activity from a distribution that is a median standard deviation. So random is the activity from fixed cost, which is helpful.
Okay, so I'm going to stop there. And that is really as good a simulation or a video, and I'm definitely going to include this in my playlists because this is a really good one. I'll do that after class. But that's it. You know, that's where we are on this stuff. So work on that. This is really essentially the last big week for us. Next week is sort of almost a wrap-up week. Let's take a look. Let's look ahead for a minute. So next week, you're going to go over models for analysis, take your end of course survey. So this is really the last hurdle for you, is to complete this. You have an example, so you know the numbers. Also pay attention to your chapters. You know, this reinforces what you need to do. So you're going to have an article about simulation and how to use Monte Carlo simulation. So that's going to kind of open that up for you. So make sure you read that. This is really good stuff. And it's no different than what we just went over. Right? But it's a very good guide in how to use Monte Carlo simulation. I kind of like it. And that's it. That should do it for you. There's and then an introduction using the random number in Excel. And here's all different examples of companies that use Monte Carlo simulations, which I told you, you know, you're going to get that. And how to use the random function. Okay, but that was the one thing I forgot to do on this. I know I did one here. When you do your own Monte Carlo simulation, every time you press the F9 key, you're gonna get, that's gonna give you, I was looking for that. I thought it was the enter key, to be perfectly honest. You know, you forget, you haven't done these things in a while. But every time I hit the F9 key, notice the numbers change. And now I get different averages. That's a simple simulation. So let's say I want to use an average of the averages. So I'll average the averages. Right, I'll average the averages. And by the way, you can go back to frequently used. So I'm going to average my averages. I have enough, I have 30. That's why I did that. Anything, again, going back to the central limit theorem, anything over, look at that, every time I hit F9, I'm getting a new average of averages, right? Which is this 46% number. And that should keep changing, anywhere between 1 and 0. And notice, because I've done all these averages, I'm getting numbers closer to 50%. If it was just one number, I'd have less of a normal distribution. It's almost like looking at the normal distribution at work, right? If I just did one randomly generated number, if I just close in the parentheses, I'm sorry, I got to, the numbers will vary a lot more. Notice you get 5%. Look at the difference between my average number and my down. Look how much one has variance as opposed to another. But because I'm doing the average of averages, I'm getting a number that's more normally distributed, which we know, according to the central limit theorem, in a normal distribution, we should be somewhere around the mean. So now I've kind of controlled for the variance. So if I was going to simulate a mortgage, and I figure that rates are about 1.5%, right? And I'm thinking about taking out a mortgage somewhere in the future, but I want to simulate my cost of borrowing, and I'm going to make that a percentage. I could multiply this by this. And it's going to make that 1.5. I don't need to make that a percent. So we'll assume 1.5 is my base rate right now. I could do that with inflation too, by the way. I don't want percent. Clear. Yeah, I'm going to clear that content. So now I'm going to make that 1.5. And for some reason, once I created it, I got to make that a normal number. Okay, now I got it. So I'm going to make that 1.5. Okay, now that'll give me a random interest rate that's based off of 1.5. So every time I hit F9, I get a different interest rate. So you could do this all day long, but remember the random generator is going to give you something between 0 and 1. So then you got to work from there, and you got to create your model from there. So that's it. I'll grade your rest of your paper sometime today. You know, your week 4 work, and the key word was Monte Carlo, and I look forward to next week and all last week. And if you have any questions on anything, give me an email or a message. Okay. Have a good day.